Have you ever wondered why some people turn a $100,000 into $1 million in under 10 years, while others with the same starting amount are still broke 20 years later? Most people think going from $100K to $1 million requires earning 10 times more income, working 10 times harder, or getting 10 times luckier. Here's what's going to mess with your head. The math that actually creates millionaires has nothing to do with earning more money. It's about making your money make money through principles that anyone can use, regardless of their salary. You've probably worked your tail off to save that first $100,000, but now you're staring at this number, wondering how the hell it's supposed to become real wealth. At your current savings rate, it'll take 30+ years to hit $1 million, and by then, inflation will have eaten half its purchasing power. Meanwhile, there are regular people, teachers, nurses, mechanics, who started with the exact same $100 you have and became millionaires in 7 to 10 years. Not through crypto luck or inheritance, but through mathematical strategies that compound wealth automatically. Today, I'm revealing 4 proven paths that turn $100K into $1 million, from conservative to aggressive, with the exact timelines and math behind each approach. Comment millionaire math if you're tired of watching your money grow at snail's speed, because what I'm about to show you will change how you see every dollar forever. But first, let me destroy the biggest lie about building wealth. 1. Why slow and steady keeps you poor. I need to tell you about the biggest financial lie that's been keeping Americans broke for decades, and it's probably something your financial advisor told you last week. My friend's dad, Robert, is a perfect example of this lie in action. Robert's been a diligent saver his whole life, maxed out his 401k every year, put extra money in safe CDs and savings bonds, followed every piece of conventional financial wisdom. He started with about $100,000 in investments when he was 35 years old. Now, 25 years later, at age 60, Robert has approximately $650,000. Sounds pretty good, right? Here's what nobody told Robert. In $1998, his $650,000 today has the purchasing power of about $400,000. After 25 years of safe investing, earning 7 to 8% annually, inflation quietly stole almost 40% of his wealth. Robert followed the rules perfectly and still got screwed by the math. Meanwhile, Robert's neighbor Mike took a completely different approach with his $100,000. Instead of playing it safe, Mike bought a duplex with $20,000 down, invested $50,000 in growth stocks, and used $30,000 to start a small business. 25 years later, Mike's worth over $2.3 million. Same starting point, radically different outcome. The lie we've all been sold is that compound interest will make you wealthy if you just wait long enough. Einstein supposedly called it the 8th wonder of the world, but here's what they don't tell you. Compound interest only works if you're earning real returns above inflation and taxes. Let me show you the brutal math that financial advisors don't want you to see. If you invest $100,000 at 7% annual returns for 30 years, you'll have about $761,000. Sounds impressive until you realize that with 3% annual inflation, you need $2.4 million in 30 years just to have the same purchasing power as $1 million today. Your successful investment strategy left you $1.6 million short of your goal. But here's where it gets really ugly. That 7% return assumes you never touch the money, never have emergencies, never make emotional decisions during market crashes. In reality, the average investor earns about 3 to 4% annually because they buy high during good times and sell low during bad times. Warren Buffett didn't become the world's most successful investor by earning 7% annually. His early returns were 20 to 30% per year because he understood something most people miss. There's a massive difference between compound interest and compound growth. Compound interest is what you get from bonds and savings accounts. Predictable but pathetic. Compound growth is what you get from appreciating assets, businesses, and investments that can multiply in value. The wealthy don't rely on compound interest. They create compound growth. Your mindset shift starts here. Stop thinking of safe money as actually safe. When inflation runs 3 to 4% annually and your safe investments earn 1 to 2%, you're guaranteed to get poorer every year. That's not safety. That's slow-motion financial suicide. But here's what most people get wrong when they hear this. They think higher returns automatically mean higher risk. That's where the real math magic happens. 2. The millionaire's math. Let me show you 4 real people I know who all started with roughly $100,000 and took completely different paths to becoming millionaires. Their stories will prove there isn't just one way to build wealth. There are multiple proven strategies, and you need to pick the one that matches your personality and risk tolerance. First, meet Jennifer, the index fund millionaire. Jennifer's a nurse who hates thinking about money and wanted the simplest possible approach. She took her $100,000 and put it all into low-cost S&P 500 index funds, then automated $2,000 monthly contributions from her paycheck. No picking stocks, no timing the market, just boring consistency. The math here is beautiful. The S&P 500 has averaged about 10 to 11% annual returns over the past 30 years. At that rate, Jennifer's $100K plus $2,000 monthly will grow to approximately $1.2 million in 15 years. Conservative, predictable, and virtually guaranteed if you can stick with it through market crashes. Then there's Marcus, who went the real estate route. Marcus used his $100K completely differently. He put $20,000 down on 5 different rental properties worth $100,000 each. Here's where leverage becomes magical. Marcus controlled $500,000 worth of real estate with just $100,000. Each property generates about $300 monthly cash flow after expenses. That's $1,500 monthly passive income right from the start. But the real wealth comes from appreciation. As those properties increase 3 to 4% annually, Marcus benefits from gains on the full $500,000. Not just his $100,000 investment. Plus, his tenants pay down the mortgages for him. After 12 years, Marcus owned 5 properties worth $1.8 million, with about $600,000 in remaining mortgages, leaving him with over $1.2 million in equity. Strategy 3 belongs to Sarah, the business builder. Sarah used her $100K to launch a digital marketing agency. She spent $30,000 on equipment and software, $20,000 on initial marketing and business setup, and kept $50,000 as operating capital. Within 2 years, her agency was generating $50,000 monthly revenue with 40% profit margins. That's $20,000 monthly profit. By year 3, Sarah's business was worth over $1 million, based on standard industry valuations of 3 to 5 times annual profit. The timeline was faster than real estate or stocks, but required more active management and entrepreneurial skills. Finally, there's David, who used the hybrid approach that most wealthy people actually follow. David split his $100K into thirds, $35 into index funds for steady growth, $35K as down payments on 2 rental properties, and $30 to start an online course business teaching what he knew about software development. This diversification gave him multiple wealth vehicles working simultaneously. The index funds provided steady compound growth, the rentals generated monthly cash flow and appreciation, and the business created active income that he reinvested into more assets. By year 8, David hit millionaire status through the combined growth of all 3 strategies. The ancient Babylonians understood this principle 4,000 years ago. Gold cometh gladly and in increasing quantity to any man who will put by not less than 1/10 of his earnings to create an estate for his future. But they also knew that different gold investments served different purposes. Here's what's crucial to understand. Each strategy has different timelines, risk levels, and involvement requirements. Jennifer's approach takes 15 years, but requires almost no effort. Marcus needed to learn real estate but built wealth and passive income simultaneously. Sarah got rich the fastest but worked the hardest. David spread his risk while optimizing for multiple income streams. Your job isn't to pick the best strategy, it's to pick the one you'll actually follow through on consistently. Because even with the right math, most smart people sabotage themselves with predictable psychological mistakes. 3. Why smart people stay broke. I have to tell you about my friend Dr. Kevin, because his story perfectly illustrates how intelligent, educated people can sabotage themselves with predictable psychological mistakes that destroy wealth-building potential. Kevin's a brilliant surgeon making $400,000 annually, and back in 2015, he had accumulated about $120,000 to invest. Kevin knew all the right strategies. He'd read every investing book, understood compound growth, even calculated that he could become a millionaire in 10 to 12 years if he just stayed consistent. But then Kevin's brain got in the way. First, Kevin waited for the perfect time to invest. In 2015, he said the market was too high after a good run. In 2016, he worried about election uncertainty. In 2017, he thought a correction was overdue. By early 2018, he finally started investing, right before the market dropped 20%. Kevin panicked and sold everything, locking in his losses. But Kevin's mistakes were just getting started. When he finally got back in the market in 2019, he made the classic over-diversification error. Kevin bought 47 different stocks, 12 mutual funds, REITs, commodities, international funds, and bonds because he'd read that diversification reduces risk. What Kevin created wasn't a portfolio. It was a chaos collection that basically matched market returns minus high fees. His smart diversification strategy turned him into an expensive index fund. The emotional decision-making mistake nearly killed Kevin's wealth building completely. During the 2020 COVID crash, Kevin sold again in March when everything was down 30 to 40%. Then he bought back in during the summer when prices had recovered. Buy high, sell low, repeat. By the end of 2020, Kevin had turned what should have been amazing returns into mediocre losses. Charlie Munger talks about inversion thinking. Instead of asking how to succeed, ask how people fail and avoid those patterns. Kevin failed at every major wealth-building principle, despite having superior intelligence and income. The other fatal mistakes that destroy wealth? Underestimating the power of consistency. Kevin would invest aggressively for 3 months, then stop for 6 months when he got distracted. Lifestyle inflation that steals compound growth. Every raise Kevin got led to a more expensive car, bigger house, fancier vacations, preventing him from increasing his investment rate. Here's what's tragic. If Kevin had simply put his $120,000 in an S&P 500 index fund in 2015 and added $5,000 monthly automatically, he'd have over $1.3 million today. Instead, after 8 years of smart investing, Kevin has about $280,000. His intelligence became his enemy because he overthought everything. The wealthy understand something Kevin missed. Wealth building is about behavior, not intelligence. The most successful investors aren't the smartest people. They're the most consistent people who protect themselves from their own psychology. Your solution is automation that removes emotional decision-making from the equation. Set up systems that invest automatically, rebalance automatically, and force consistency even when your emotions are screaming to do something different. Kevin's story proves that knowing what to do isn't enough. You need systems that ensure you actually do it, especially when markets get scary, opportunities arise, or life gets complicated. Now let me show you the exact step-by-step action plan that makes wealth building inevitable, regardless of your personality or market conditions. 4. The Millionaire Action Plan. Let me tell you about my friend Lisa's transformation, because her systematic approach to turning $100K into $1 million is exactly what you need to follow. When Lisa started this journey 2 years ago, she was completely overwhelmed by all the wealth-building strategies she'd learned. She knew the math worked, but she didn't know where to actually begin or how to implement everything without screwing it up. Lisa's breakthrough came when she realized that becoming a millionaire isn't about making one perfect decision. It's about following a systematic plan with specific phases, each building on the last. She treated wealth building like a construction project. Foundation first, then structure, then optimization, then scaling. Phase 1 took Lisa 6 months and was all about creating an unshakable foundation. She started by optimizing her emergency fund, not the traditional 6 months of expenses that financial advisors preach, but a calculated 3 months in high-yield savings plus a $10,000 credit line she never planned to use. This gave her security without oversaving. Next, Lisa eliminated her $8,000 credit card debt using the avalanche method, then set up automatic investment transfers that happened the day her paycheck hit her account. By month 6, Lisa had systems running automatically that required zero willpower or daily decisions. Phase 2 was where Lisa's wealth started accelerating. Years 1 through 3 focused on maximum contribution strategies and tax optimization. Lisa maxed out her 401k, $2,500 annually, maxed her Roth IRA, $6,000, and invested an additional $2,000 monthly in taxable accounts. But here's where Lisa got smart. She also launched her real estate journey with a house hack, buying a duplex and renting out one side. The rental income covered most of her mortgage, essentially giving her free housing while building equity. By year 3, Lisa had over $280,000 in combined assets. Phase 3 is where Lisa currently sits, and it's all about optimization for higher earners. Years 3 through 7 focus on advanced strategies that only make sense once you have substantial assets. Lisa started a solo 401k for her consulting side business, allowing her to contribute up to $66,000 annually in tax-advantaged accounts. She purchased her second rental property using a combination of saved cash and a cash-out refinance on her first property. She also implemented tax loss harvesting in her taxable accounts and started using a backdoor Roth conversion strategy. The beauty of Lisa's approach is that each phase built naturally on the previous one. She didn't try to do everything at once, which is where most people fail. Instead, she mastered one phase before moving to the next, creating sustainable momentum rather than overwhelming herself. Sun Tzu wrote about the importance of strategic planning. Every battle is won before it is fought. Lisa's wealth building follows this principle. She wins through systematic execution, not through picking perfect investments or timing markets. Phase 4, which Lisa will enter around year 7, focuses on multiplication and legacy planning. This is where you leverage established assets for business expansion, advanced real estate strategies, tax-free wealth transfer techniques, and true passive income that exceeds your living expenses. Your implementation starts this week. Set up one automatic system that moves money from checking to investments without your involvement. Pick your primary wealth vehicle, index funds, real estate, or business, and take the first concrete step. The magic isn't in the complexity, it's in the consistency of following a proven system. The math is proven, the strategies work, and now you have the roadmap. But there's one final piece that determines whether you'll actually follow through with this plan or just think about it forever. There you have it, the mathematical truth about turning $100 into $1 million. 4 proven paths: conservative index investing over 15 to 20 years, real estate leverage in 10 to 15 years, business building in 7 to 12 years, and hybrid approaches that optimize timelines while spreading risk. The math works. The strategies are proven. Jennifer, Marcus, Sarah, and David all started where you are now and became millionaires using these exact approaches. Dr. Kevin proved that intelligence without systems leads to failure, while Lisa proved that average people following systematic plans achieve extraordinary results. Here's the uncomfortable truth. You're holding $100K worth of potential right now. In 10 to 15 years, you'll either be a millionaire or you'll still be wondering, what if? The difference isn't luck, market timing, or special knowledge. It's your willingness to pick one strategy and follow through consistently. Your action step. Choose one strategy that matches your risk tolerance and implement it this month. Set up the automatic systems that remove emotion from wealth building. Stop researching and start executing. Comment strategy choice and tell me which path resonates most with your situation. Share this with someone who's sitting on money but not sure how to multiply it. Should I break down the exact real estate strategy that can accelerate your timeline to 7 years? Your first 100K proved you can build wealth. Your next million will prove you can build freedom. The math is on your side. Now trust it enough to act.